Hey everyone, welcome back to Corporate Dakota. Today, A.D.I.C just filed its semi-annual shareholder report for the 31st of March 2026, and I am seeing a clear trend in their expenses. Quick note, this is not financial advice, just my take on public filings for educational purposes. While the market has been tough, this fund shows a surprising stability in its costs, even as its investments are fluctuating. Alright, let's dive into the details of this filing from the advisor's Inner Circle Fund III. This is a look at their performance over the first 6 months of 2026, ending the 31st of March. First up, let's talk about costs. They break down how much a hypothetical $10,000 investment would have cost over these 6 months. For the Democratic Large Cap Core ETF, that cost was just $22. That is a tiny fraction, only 0.45% of that hypothetical investment. This tells us that for investors, the actual out-of-pocket for fees and expenses on a smaller investment is quite low, which is generally a good sign if the fund is performing well. Now, for some key numbers as of the 31st of March 2026, the fund had total net assets of almost $54.3 million. It held 45 different investments, which means it's not overly concentrated. The total advisory fees paid were about $117,700, and the portfolio turnover rate was 19%. This turnover rate is important. It means they bought and sold about 19% of their holdings during this period. A lower turnover rate can suggest a more long-term investment strategy, which often means lower trading costs and potentially fewer taxable events for investors compared to a fund that trades very frequently. Let's see where the money was actually invested. Sector weightings give us a good idea of the fund's focus information. Technology was by far the largest chunk at 38.6%. This means the fund is heavily invested in tech companies, which can be a growth engine but also carries higher risk if that sector takes a hit. Communication services and industrials were next, about 13.6% and 13.3% respectively. Then we have financials at 9.1%, healthcare at 6.2%, consumer staples at 6.1%, consumer discretionary at 5.7%, real estate at 3.7%, and finally materials at 3.2%. The fact that information technology is such a large portion of the portfolio is the main story here. Digging deeper, the top 10 holdings give us a clearer picture. Apple makes up 5.1%, Nevada EDIA 4.9%, and Microsoft 4.8%. Next up are Costco Wholesale and Louis, both at 4.6%. Then Lam Research and Kelly at 4.3%, followed by Amphenol at 4.3%, Nordson at 4.0%. And Xylem at 3.5%. Notice that the top three are tech giants, reinforcing that heavy tech concentration we saw in the sector breakdown. A high concentration in a few large companies can be good if those companies do well, but it also means the fund's performance is very tied to the fortunes of these specific giants. Looking at the statement of assets and liabilities, we see total net assets at $54,309,688. This is made up of investments valued at roughly $54 million with a cost of a little over $45 million. There is also a bit of cash and some receivables. On the liabilities side, there are very small amounts, mainly for management fees totaling just over $17,500. This low level of liabilities is quite positive, meaning most of the fund's value is directly attributable to its investments rather than debts. Now, let's check the statement of operations for the 6 months ended the 31st of March 2026. Investment income from dividends was $245,824, but then expenses, primarily management fees, were $117,695. This leaves a net investment income of about $128,129. On the flip side, the fund saw a net realized loss on investments of $144,977. And there was a significant unrealized depreciation, meaning the value of the investments dropped by $1,797,061. All of this resulted in a net decrease in net assets from operations of $1,813,909. So even though they earned some income, the overall value of the fund went down during this period, largely due to market depreciation in their investments. Looking at the financial highlights, the total return for the 6 months ended the 31st of March. 2026 was negative 2.82%. This matches what we saw in the statement of operations, the fund lost value during this period. For comparison, in the year ended the 30th of September 2025, the total return was a much healthier 16.76%. followed by a very strong 37.66% in 2024. This highlights the volatility in investment performance, especially in a sector like technology where this fund is heavily invested. The fact that this fund saw a drop in a period where it previously saw strong gains suggests market headwinds in the tech sector. The ratio of expenses to average net assets is noted as 0.45%, and it is the same for the 6 months ended the 31st of March 2026, as it was for the full previous years. This stability in expense ratio, even with fluctuating asset values, is a consistently positive point. It shows that the fund managers are keeping costs tightly controlled. In the financial highlights, the net asset value per S-Hair at the beginning of the 6-month period was $41.8. By the end, it had dropped to $40.23. This is a decrease of about $1.57 per S-Hair, representing that negative 2.82% total return we just discussed. This downward movement reflects the market conditions that impacted the fund's holdings. Digging into the notes, we learn the advisor's Inner Circle Fund, the third, is organized as a Delaware statutory trust, with this specific fund, the Democratic Large Cap Core ETF, aiming to track a Democratic Large Cap Core Index. It operates as an exchange-traded fund, or ETF, meaning its shares trade on a stock exchange like NASDAQ. The investment advisor is Reflection Asset Management, LLC, and the sub-advisor is Exchange Traded Concepts. LLC, the fund started operations on the 2nd of November 2020. This structure means that while the fund has a net asset value, its market price can fluctuate throughout the day based on supply and demand. Under significant accounting policies, they mention that the financial statements are prepared according to US generally accepted accounting principles, or GAAP. They emphasize that the preparation involves estimates and assumptions, which is standard. A key point here is security valuation. Most investments are valued at the last quoted sale price or the most recent bid price. For securities where market prices aren't readily available, they use fair value procedures. This is important because it shows they have a process for valuing less liquid assets. They also talk about the fair value hierarchy, with level 1 being quoted prices in active markets, level 2 being other observable inputs, and level 3 being unobservable inputs. For this fund, as of the 31st of March 2026, all investments were considered level 1. This is a really strong indication that their holdings are highly liquid and have readily available market prices. Regarding federal income taxes, the fund intends to qualify as a regulated investment company, which generally means it passes through income and gains to shareholders, avoiding corporate income tax. They don't expect to owe federal income taxes. Security transactions are accounted for on the trade date. They use specific identification for determining realized gains and losses, which is a common accounting method. Dividend income is recorded on the ex-dividend date. In transactions with affiliates, they mention that some officers of the trust are also employees of Sadie Investments Global Fund Services. These officers don't get paid by the trust directly, except for the Chief Compliance Officer. This indicates a potential for related party transactions, but the oversight structure seems to be in place. Under these agreements, Say Investments Global Fund Services acts as the administrator, and Say Investments Distribution Company is the distributor. Brown Brothers Harriman and Company is the custodian and transfer agent. For the period we're looking at, the fund did not incur any distribution or shareholder services fees. This again points to very low operating costs for the investor. This is a crucial section. The main advisor, Reflection Asset Management, gets paid a fee calculated at 0.45% of the fund's average daily net assets. The sub-advisor, Exchange Traded Concepts, receives 0.04% from the advisor. With a minimum annual fee, the key takeaway here is that the total advisory fee rate for the investor is effectively capped at that 0.45%, which is quite competitive, especially for an ETF. The advisor covers most of the fund's expenses except for advisory fees, interest, taxes, and brokerage commissions, which further limits costs for the investor directly. The fund purchased $18.2 million and sold $10.2 million in investment securities during the 6 months. The report notes that these figures exclude the effect of securities received or delivered from in-kind creations and redemptions, which is good for calculating portfolio turnover accurately. This section details the tax character of distributions paid. For the year ending the 30th of September 2025, distributions were entirely ordinary income. They also provide a look at the tax components of distributable earnings as of the 30th of September 2025. The unrealized appreciation was over $10 million on paper, suggesting significant potential for future taxable gains, if those unrealized profits are realized. The report also states the difference between federal tax cost and book cost primarily relates to wash sales, which is a common tax loss harvesting strategy. Now, this is where we get into the risks. They cover equity market risk, meaning stock prices can fall, common stock risk, that common stock is subordinate to debt, large capitalization risk, that big companies might struggle to adapt. Importantly, they highlight information technology sector risk, clearly stating that the fund is exposed to issuers in this sector and that legislative changes, competition, or product cycle issues could negatively impact these investments. There is also issuer-specific risk and ETF risks like index tracking risk, passive investment risk, and trading risk where the market price can differ from the NAV. Notably, they mention methodology risk related to the underlying index, and even acknowledge that the index's reliance on FEC data for political contributions could lead to the inclusion of companies that might not otherwise qualify. This is a very thorough list of potential downsides. In the other section, they clarify that all shares issued were in creation unit aggregations to authorize participants, but individual shares are traded on the exchange. Standard stuff here about general indemnifications from contracts, with the risk of loss considered remote. They mention adopting a new accounting standard for income tax disclosures, but state it only impacted disclosures and not the fund's financial position or results. No additional disclosures or adjustments were required from subsequent events, indicating stability, and no major events occurred immediately after the reporting period ended. It is worth noting the investment advisor, Reflection Asset Management, LLC, is based in Isle of Palms, South Carolina. The sub-advisor, Exchange Traded Concepts, LLC, is in Oklahoma City, Oklahoma. The administrator and distributor are both SE Investments Distribution Company in Oaks, Pennsylvania. Now, looking at these results more broadly, what stands out is the very low expense ratio of 0.45% consistently maintained. This is a significant strength for any fund, especially in periods of market downturn. However, the fund's heavy concentration in the information technology sector, which comprises almost 40% of its holdings, is a notable risk. The recent negative total return of 2.82% for the 6-month period reflects the current challenges in that sector. While the fund is designed to track an index, the performance clearly shows the impact of market fluctuations on its heavily weighted tech investments. The fund's management has kept expenses extremely low, which is commendable, but investors need to be comfortable with the sector, specific risks, and the potential for volatility associated with a large allocation to technology. The risk I am watching is the continued performance of the information technology sector and how that impacts the fund's ability to recover its recent losses and potentially outperform in the future. My biggest concern is that without a significant shift in sector allocation, a prolonged downturn in tech could disproportionately affect this fund's returns. What I'm actually looking for is a more balanced sector exposure or a clear sign of resurgence in the tech companies it holds. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord.